So we all know that under interpretation of financial statements, which we call the ratio analysis, we have a lot of uh, tools that we use, the ratios that we use, and one of them is the investment ratios, the ratios that are relating to the owners or the investors ratios. And we know that one of the important ratios there is the earnings per share. What is the earnings per share trying to measure? The earnings per share is just trying to measure the the share on every one city that or the earnings on every share. If you're having a share, what will be the earnings? If we are distributing the earnings, what will be the portion of the earnings that you'll be getting on a share? So the earnings per share is just trying to say, okay, if we are to distribute all the earnings among the shareholders, the earnings attributable to the shareholders, that is after paying preference dividend and all those things, the earnings that is to be returned, the earnings that is to be returned by the entity or the earnings that is attributable to the owners of the company, if it should be distributed among the owners. If you're having one share, how much of the earnings will you be getting? That is basically the earnings per share. So it measures the earnings per share that you are having. Okay. Under the ratio analysis, we calculate the earnings by taking the earnings attributable to equity shareholders and by dividing it by what? The total number of shares that they have. So what we do is that we say that the earnings per share is just the earnings attributable to the ordinary shareholders over the number of shares. Okay. That is how we calculate the earnings under the ratio analysis. This particular calculation of the earnings is done without taking into consideration when the shares were being purchased. Okay. It can happen that the company at the beginning of the year, at the beginning of the year, at the beginning of the year, the entity is having 20 million shares. Okay. August 1, at August 1, at August 1, or at the beginning of August 2021, which is the current year, the company issue additional shares of 10 million. Under the earnings per share, when we are calculating the ratio, what we do is that we just use the 30 million to calculate what? The earnings per share. But in actual sense, the contribution that the 20 million will be making towards the profit for the year will be different from the contribution that the 10 million will be making towards the profit for the year. The two of them is not going to be having the same contribution towards the profit for the year. One is at the beginning, so that one will be used from the beginning to the end of the year. So it's going to generate profits for the full year. But one that is being issued on 1st August, September, October, November, December, that is 5 months. So it means that this particular number of shares is going to generate profit for only 5 months. It's going to generate profit for only 5 months. But what we do under ratio analysis is that we assume that all the shares are issued at the beginning of the year, and we use all the 30 million to calculate our earnings per share. Now, what you are doing is very wrong, because if you are introducing shares at the beginning of the year, that particular share will contribute towards the profit for full year. But if you are issuing shares 5 months to the end of the year, it means that that particular shares will only contribute to the 5 months worth profit. So for the earnings per share itself, which we are going to look at under the 33, the earnings per share under the 33 take into consideration when the share is issued. When the share is issued. And the assumption is that the timing of the shares, or at the time that the share is issued, will have the same effect on the profits. So if you are issuing the shares at the beginning of the year, it means that the shares is going to generate profit for the full year. But if you are issuing the shares 3 months to the end of the year, that particular shares will only have 3 months impact on the profits. So what portion of the profit is, or what portion of the shares that is having the impact on the 3-month profit? So the time that the share is issued will have the same number of period impact on the profits. So if you're having 20 million shares, we assume that the 20 million is going to be the only shares that will be used to generate the profit that we are going to be generating. But if you are issuing additional shares at the start of August, it means that that particular shares will start generating profit from the start of August to the end of the year. So if you come to the earnings per share, we take into consideration the impact that the shares will be having on the profits. So if you issue shares at the start of the year, it's going to have a full year. It will be used for full year. So it's going to generate profit for a full year. But if you issue shares at the start of the second half of the year, which is 1st July, that particular shares will be used to generate profit for 6 months. So what portion of the shares will be used to generate profit for 6 months? We find 6 months of that particular share. So for earnings per share, if you come to 33, earnings per share is calculated as the earnings attributable to the earnings, which is the ordinary holders' earnings, over what we call the WACC. Okay, the WACC take into consideration the impact that the shares is going to be having on the profits. So if the shares are there at the beginning of the year, it will have a full year impact on the profits because you'll be using the shares for the full year. So it's going to be generating profit for the full year. But if you are issuing the shares at the start of September, that will have only 4 months impact on the profit. So what portion of the shares is having, or what portion of the shares is the company using to generate that particular profit? So that is what we call the WACC. That's what we call the WACC. Okay, so if you are calculating the earnings per share for a single entity, okay, that is what we call the basic earnings per share. Okay, basic earnings per share. So the basic earnings per share is the profit attributable to the ordinary shareholders, okay, over the WACC. Over the WACC. Okay, the standard talks about 2 types of earnings per share. So we have the basic earnings per share. We also have the diluted earnings per share. Okay, we are going to look at them one by one. We look at the basic earnings per share first, then we look at the diluted earnings per share. But what you have to know is that if you are generating a profit of 20 million for the year, the profit is 20 million. Okay. At the beginning of the year, beginning of the year, you have shares, 15 million shares. Okay. And at September 1, you issue additional shares of 10 million. Okay. Which of these shares will be used for the full year? Which of these shares is going to be having a full year impact on the profit? Which of these shares?
The 15 million.
Okay. But the 10 million, how many months impact?
4 months.
That will be
4
4
months.
months. Okay. So if you are using all the 10 million, the assumption is that you are saying that the 10 million has been there from the beginning of the year to the end of the year. That is not the case. The 10 million was issued at 1st September 2021 or 2022. So these particular shares will be used for only 4 months. So it's going to be having only 4 months impact on the profits. It is being used to generate only 4 months profits. So what portion of it is used to generate the 4-month profit? So we find that particular one and strike it against the profit that it has generated. So that's how we go about it. It's very simple. That's how we go about it. But the earnings, the profit attributable over here, we are talking about. So let's look at the profit. What profit do we use? Okay, the profit that we use for the earnings per share is profit attributable to the Ordinary shareholders. So what are the things that we take into consideration before calculating the earnings per share? So the earnings will be the profit after tax. Okay. Minus the preference dividend. But what are the preference dividend? What preference dividend do we take into consideration? What you have to know is that under financial instrument IFRS 9, under financial instrument IFRS 9, redeemable preference shares, their dividends are treated as what? As finance costs. If you come to financial instrument, redeemable preference shares, dividends are treated as finance costs. So that one is already charged against the profit. So we don't take the preference dividend or redeemable preference dividend from the earnings. It has already been charged as a finance cost. Take note of that. But if you come to irredeemable preference shares, the irredeemable preference shares are those shares that will not be redeemed. They will be there with the company forever. So what they will do is that they are charged to statement of changes in equity. They are treated as if they are what? Ordinary dividends. They charge them to statement of changes in equity. So what we do is that we take redeemable preference dividend over here because it hasn't been taken from, okay, so redeemable preference dividend will be subtracted because it hasn't been taken from the profit. So redeemable preference dividends. Okay. You can also see the question will also say non-cumulative preference dividend or non-cumulative preference shares or non-cumulative preference dividends. If you are talking about cumulative preference shares, they are those shares that if the company is not able to pay dividend this year, the dividend will be carried out to the next year. So it is more like debt. It's more like interest. If you don't pay the interest this year, you are going to be paying the interest next year. So it's more like what? Debt. But if you come to non-cumulative, whether you make profit this year or not, or if you don't make profit this year, you're not going to pay any dividends in the future concerning this year. So if you don't make profit this year, no dividend will be paid, or the dividend will not be accumulated, and which will be paid together with what? Maybe subsequent dividend. No. So the non-cumulative dividend is the non-cumulative preference shares is more like equity. It is treated like equity because for the equity shares, if there is no profit, no dividends. So it is same like the non-cumulative preference shares. If there is no profit, we are not going to pay dividends. And this particular dividend will not be accrued to the subsequent year. So the non-cumulative preference shares are also seen to be ordinary shares. So the non-cumulative preference dividend will also be subtracted from the profit after tax for us to get the profit attributable to you. So non-cumulative preference dividend will also be subtracted. Non-cumulative preference dividend will also be subtracted. Okay. You also have a dividend that will be, they can also say convertible preference shares, or they can also say preference shares, which is cumulative, or it can be any of them. But what they are going to say is that the preference shares will be convertible. But the question is, who has the option to call for the conversion? Who has the option? Is it the holder or the company? Is it the holder who has the option to convert it, or is the what? Is the issuer? Okay. If it is the holder, like you are the one who is having the shares, you purchase the shares. So if you are the one having the option to convert, it is likely that you are going to convert it if things are okay. So if that is the case, the preference dividends will still be treated as debt. Okay. But if it is the issuer, the company who has the right to what? To call for the conversion, it is likely the company will never call for it. So what will happen is that that particular dividend will also be treated as what? As irredeemable preference dividends. Because there is no way I will call you or I will say that, okay, the shares should be converted to what? Equity shares or something. So it will be treated as shares that is going to be with the company forever. So sometimes they will say that, okay, preference shares, but it can be converted to equity shares, and it is the issuer that will call for the conversion. In that case, the company will never call for the conversion. So the preference dividend will still be treated as what? Irredeemable preference dividend, and that will also be subtracted from the profit after tax. So you have to take note of the dividend that you are going to be subtracting. Preference dividends, redeemable preference dividends are treated as finance costs under financial instruments. It's only redeemable preference shares that are treated in statement of changes in equity. It means that they are not taken from what? The profit after tax. Non-cumulative dividends are also treated in statement of changes in equity. They are not taken from the profit after tax. Preference dividend that is convertible at a future date, but it is the issuer who has the option to convert. That dividend is also treated as a redeemable preference dividend. So it has also not been taken from the profit after tax. You have to take it. All right. If you come to the WACC is not anything. We just time apportion the shares based on the impact, based on the contribution that they have made to the profits. That is all. This is for a single entity. Sometimes the question can ask you to calculate it for what? A parent company. Or they will give you a consolidated financial statement. They will ask you to calculate earnings per share. The earnings per share will only be calculated for the parent company. Will only be calculated for the parent company. The non-controlling interest now will be treated as a form of what? A form of a liability. So we don't do calculation for what? For the subsidiary, because the subsidiary shares have been consumed by what? The parent and also the non-controlling interest. So if you are calculating earnings per share for a parent holding, parent company, earnings per share for the parent company, what we do is that our profit that we are going to be using will be the parent share of the profit. So profit after tax, which is a group profit minus the NCI share of the profit, divided by the WACC. The WACC will be on the parent what? Shares. So you take your non-controlling interest, or you look for your profit, the parent share of the profits, then you divide it by the WACC of the parent, taking into consideration the parent shares. All right. Okay. So we are still on the basic earnings per share. And for the basic earnings per share, we have three things that can what? Increase the basic earnings per share. All right. Well, we have three issues that is affecting the basic earnings per share. The first one is issue at a full market value. So we look at issue at a full market value. Issue at a full market price. Okay, issue at a full market price. The issue at a full market price is not anything. It's just that the parent has share, the company has shares at the beginning, and during the year they have made additional issue of shares. So what will be the impact on the shares now? So let's assume that the company has 10 million shares outstanding. So 10 million shares outstanding. You have to know the difference between authorized shares and outstanding shares. The outstanding shares are the shares that have been subscribed to. The authorized shares is the maximum number of shares that the company is being legally authorized to issue. So the total number of shares that a company is qualified legally to issue is the authorized shares. But the shares that is currently trading, the shares that the shareholders have subscribed to, is what we call the shares outstanding. So the company has 10 million shares outstanding at the beginning of the year. Okay. Okay, August. Let's look at August. Okay, August 1, 2021. The company made a full market issue of 5 million shares. Okay, the price is not necessary. We are only looking for the shares. Okay, the profits after tax of the company for the year is the profit after tax is 5 million. Okay, so they're asking you to calculate the basic earnings per share. So we are asking us to calculate the the basic earnings per share. All right. Okay. Out of these two shares, which of them is going to be having a full year impact on the what? On the profit? Out of these two shares, which of them is going to be having a full year impact on the profit?
The 10 million
Okay.
shares.
The 10 million. The 10 million is going to have a full year. So the 10 million will be there from the beginning. So you look at the old shares or the existing shares. So you can say existing shares. That is going to be 10 million. It will be there for 12 months. So 12 over 12. So that will still give you 10 million. Okay. But let's count to new issue. The new issue will have how many months impact?
5 months.
So let's find the 5 months of the shares. So the assumption is that the 5 million is for the total year. So let's find 5 months. That will be 5 million times 5 over 12. What are we getting? I'm getting 2.1. Is that correct?
Yes, please.
Okay. So that is one way of what? One way of calculating the WACC. The WACC, you just ask yourself, what is the shares outstanding? That will be there for 12 months. So it will still have a 1 year impact. So the 10 million. But the new issue have how many impacts? How many months impact? You calculate it and add it. Or alternative way of doing it is this one, which is always going to be confusing you. But let's see. So we have the old shares. Okay. How many months would the old shares going to be? The old shares will do how many months before the new issue?
7 months.
So we'll calculate 7 months out of it. Okay. So 7 months out of it will give us how much?
5.8.
5.8. Okay. Okay. So from 1st August, what will be the total number of shares now? Or from 1st August, how many shares will be used out to the end of the year? That will be 15 million, isn't it?
Yeah.
Okay. Times 5 over 12. That will give us how much?
6.3.
I'm getting 6.25.
Yeah, 6.25. Because you converted the others, that's how much for it.
Okay, so 6.3. What are you getting? 12.1, isn't it? Will it still be 12.1?
Yes, please.
Okay. So our basic earnings per share will be equal to the 5 million divided by 12.1. What are we getting? 0.41, isn't it?
Yeah, 0.41.
But the earnings per share is calculated in the highest denomination. So if you're having 0 point something, you change it to pesos. So we don't have 0.41. No, that is in cedis. So change it to what? Pesos. So we have 41 pesos per share. Okay. That is how we go about the what? The the new market value issue. But let's pick a question. Let's pick the question one here. That is on market value issue. Then we finish it. Then we go to what we call bonus issue and a right issue. Then we look at a combination of the two. Then diluted earnings per share. Okay. Okay. A Limited has earnings of 300,000 during the year ended 31 December 2016. On 1st January 2016, A has share capital of what? Of 100,000. Okay. On 1st March 2016, a further 60,000 shares were issued at 3.25 per share. Calculate the basic earnings per share. Okay. So let's come to the question one. A Limited. Okay. So what is the shares outstanding? What is the shares at the beginning? Or let's look at the earnings first. The earnings was 300,000. Okay. Shares at the beginning was 100,000. Okay. On March 1, 60,000 shares were issued. 60,000 were issued. Okay, 60,000 were issued. Okay. So what we now have to do is we have to calculate the WACC. Okay. So let's now compute the WACC. Okay. The old shares is going to be there for how many months? The old shares will do what? Will do the full year, isn't it? They will be at the beginning.
Yeah, 12 months.
So that will do 12 months. So you can decide to just pick them like that because it's going to have a full year impact. So you can just do 12 over 12. It's going to have a full year impact. So that will be 100,000. But from March to December, what are we going to be having? It will be 60,000 times 10 over 12. Is that correct? Is that 10 over 12 correct?
Yeah.
All
No,
right.
it should be
Yeah,
9.
it's 10.
It's 10. Eh?
It's,
Okay.
it's March 1, so 10.
Okay. So
Oh,
what
okay.
are we going to be having? 10 over 12 times 60,000. I'm having 50,000.
Yeah,
So that will give us 150,000, isn't it? Okay. You can also calculate it alternatively like this, where you are going to consider only the shares that you have at the beginning. Then you now consider from the time of the new issue to the end of the year. So if you have the old shares will do January and February before the new issue. So that will be 100,000 times 2 over 12. Okay. Then you count to March to December. You will now have 160,000, which will be the total shares times 10 over 12. Whatever be the case, you have to be getting 150,000 at the end. Okay. So 2 over 12 times 100,000. Having 16666. Okay, it should be 16667. Okay. I'm going to be having 1333333. Okay. So whatever be the case, you will still be having the 150,000. But if you are okay with the first one, where the old shares will be doing a full year, then you only what time apportion the the new one. That is all. So our basic earnings per share will be equal to the earnings, that is 300,000, divided by 150,000. What are we getting? We are getting 2 CD per share. So if it is already in 2 cedi, we don't do anything. But if it should be 0 point something, that is why we change it to pesos. So the 2 cedi is still okay. All right. It should not be in decimals. The answer should not be in 0 point something. No. Okay. It should be a whole number. All right. So that is about the issue at the full market value. It's very simple. It's very simple. Sometimes they can give you the issues like 3. You don't have to do anything. You just have to time apportion it. You just have to time apportion it. That is all. So maybe you have the existing shares will be 100,000. So they made a first issue at 1st March. Maybe July 1, they made another issue. So you just time apportion them one by one. This will do 10 months. This will now do 6 months. So you just time apportion them one by one and put all of them together. That is all. All right. Let's come to another issue. What will also increase the shares of the company? What will also increase the shares of the company? Okay, the first one is what we call a bonus issue. What we call a bonus issue. All right. The bonus issue, we are just changing our reserves to equity. Okay, the reserves has been there forever. So the assumption is that since the reserves have been there forever, it means that the shares has been in issue from the start of the company, but just that we keep the shares in the reserves. So we are just not transferring it from reserve to the equity share capital. So no matter when the bonus issue is done, it will be assumed to be in existence since it will be assumed to be in existence from the time the company started operating. So bonus issue on existing shares is not time apportioned. So if you have the 100,000 and 30th November, the company made a bonus issue of 142. We assume that the 142 has been done at the beginning of the year or at previous year, and it will be assumed to be in an issue from the time that the company starts operating. So bonus issue on existing shares is not time apportioned. You have to pay very much attention to this one. Bonus issue on existing shares is not time apportioned. A company can issue shares. There will be a full market value on July 1 to the end of the year. Then maybe somewhere August, the company will made a bonus issue. The bonus issue will only affect July from July. So it means that a bonus issue on this one will be time apportioned for 6 months. That's why I'm saying that bonus issue on existing share or bonus issue on existing shares at the beginning of the year is not time apportioned. But bonus issue on a full market share within the year will be time apportioned based on the number of months that the full market issue has done. Okay, so bonus issue is not time apportioned. And if there's a bonus issue, the bonus issue must be calculated retrospectively. So if there is any special that you have calculated for the previous year, we assume that the bonus issue has also been in existence for the previous year. So you have to go and recalculate your earnings per share for the previous year. All right. Take note of this one. The company can also do a share split or stock split or a reverse issue. If the company did a reverse issue, it means that a reverse issue is also like a bonus issue. A reverse issue is like a bonus issue. Stock split is also treated as a bonus issue. Or share split is also treated as a bonus issue. It's not time apportioned. And it will be having a retrospective effect. So sometimes the question can say there was a stock split. The stock split is that we are just, maybe the value is 1 cedi. Now we are making it to be 50 pesos so that the number of shares will increase. That will also be treated as a bonus. It will be treated as if it's a bonus issue. So it will be having a retrospective effect. So you can see a reverse issue, a stock split or share split. It should be treated as if it's a bonus issue and it will not be time apportioned. You can also see a question and they will say that the company has purchased its shares back, which we call the treasury shares or the share repurchase. So if when is the company buying the shares back? That portion of the shares that they are buying have been in issue. So it's going to have some impact on the profit to the time that they repurchase it. So you have to time apportion to the time that it was repurchased. So you have to take note of all those issues. Bonus issue is not time apportioned. That is the first one. Bonus issue is not time apportioned. Or bonus issue on existing shares at the beginning of the year is not time apportioned. But a bonus issue on a full market value during the year is time apportioned. All right. If there is a bonus issue, there are so many ways of calculating the bonus issue or the shares that are being issued as a bonus issue. The question will say that it has been issued at 142. Okay. The understanding of this 142 is very important. The 142, this is the new shares. The first one is always the new share. So we are giving you one for every existing shares, every 2 existing shares that you are currently having. So if you want to calculate the number of bonus issue, it's just the first number divided by the second number multiplied by the existing shares that you have. So 142, it can be 243, it can be 245. I'm giving you 2 new shares for every 5 existing shares that you are currently holding. And it's calculated as the first figure over the second figure. That will give you the bonus side. Okay, so I will show you what we call a bonus fraction. Okay. Let's assume that the company is having 10,000 shares. The company is having 10,000 shares now, and they made a bonus issue of 142. What will be the bonus issue? What will be the bonus issue? It will be 1/2 times 100,000. Am I correct?
Let's say 10,000.
Okay. 142 will be, so 100,000. Okay. So 142, you are bringing 2 of your existing shares for 1. So how many of your existing shares can you bring for 1 new share? It will be 50,000. So that will be 1/2 times the 100,000. So we'll be having a 50,000 shares. What will be the total number of shares after the bonus issue? Total number of shares after the bonus issue will give us what?
150,000.
So that will be the 100,000 plus what? 50,000. Okay. We can say that this is the same as 100% of the existing shares, which we always call the 1, plus the bonus fraction. So 100% of this one plus the 50% of your existing shares, they will give you that one. So let's look at this. The SCM over here is 2. Okay, the SCM over here is 2, and this is over 1. So we have 2 plus 1, and that will give us 3/2. The 3/2 is what we call the bonus issue. So you can decide to find your 150,000 by applying 3/2 multiplied by the 100,000. You'll be having 150,000 straightforward. So this is what we call the bonus fraction. How do we calculate the bonus fraction? The bonus fraction will be bonus fraction, a bonus issue fraction will be calculated as the shares after the bonus issue, divided by the shares before the bonus issue. So the shares after is 150,000 and before is 100,000. You can see that this is the same as 3/2. Or sometimes you can use the unit base. I'm giving you 2 for 1. So it means that I will still be having my 2, then I'll be adding a 1 to it. So the shares now on unit level will be what? 3, and the existing shares will now be 2. So that is the bonus fraction. All right. So how do we use the bonus fraction? If we are calculating a comparative earnings per share, we turn the bonus fraction upside down to calculate our what? Our existing or our previous earnings per share. Okay, let's take example. Assuming our earnings for this year is 50,000. Okay. And our shares at the beginning, our shares at the beginning, our shares at the beginning, our shares at the beginning was 100,000. Okay. The company now made a bonus issue. The bonus issue, it doesn't matter when it was made. If it is on existing shares at the beginning of the year, the time doesn't matter. So the company made a bonus issue of 142. Okay. So if the company made a bonus issue of 142, the bonus issue, we now calculate our total number of shares now. Total number of shares, assuming that the bonus issue has been there for long. So that will give us the 100,000 plus 1/2 multiplied by the 100,000. That will give us 150,000. This is now the total number of shares. So our basic earnings per share for this year, basic earnings per share for this year will be the 50,000 divided by 150,000. That will give us 1/3, which will give us 3 point something something. So 1/3, 1/3 times 100. Okay, that will give us 33.3 per share. Okay, 33.3 pesos per share. All right. Sometimes the question can give you the earnings per share for the previous year. So let's assume that this is 2021. Okay, the question can tell you that the earnings per share for last year, the last year was 40 pesos. So 2020, so they can tell you that the 2020 earnings per share, 2020 earnings per share was 40 pesos. Okay. We are saying that whenever there is a bonus issue, we are assuming that the bonus issue has been in existence since. So it means that the bonus issue has been in existence for the previous year too. So what we do now is that the previous year, the shares that the company used, the shares that they used for the calculation of the earnings per share was 100,000, which in actual sense should have been 150,000 because the bonus issue will also be assumed to be in existence in the previous year. So the question now is, how do we find that? Let's find our earnings for last year. Let's find our earnings for last year. How can we find the earnings for last year? The earnings will be the number of shares multiplied by the earnings per share. Am I correct? The earnings.
Yes, please.
Okay. So the earnings will be the earnings per share times the number of shares. Okay, we just change the earnings per share formula. So this will be 0.4 times 100,000. So this will be 40,000 for last year. Our earnings will be 40,000. So let's now calculate the new earnings per share for last year. It will be the 40,000 divided by 150,000 shares now, which will be the bonus issue plus that. Okay. So we have 40,000 divided by 150. What are we getting? Yeah, Deborah, the one is up.
27 pesos.
Hello, sir.
27.26 points. Yeah, Deborah.
Okay, so is the bonus fraction not 3/2 by 1/2?
That is not a bonus fraction. That is we are just finding the shares relating to the bonus issue. The bonus fraction will be the total fraction that you can use to calculate your total number of shares. So the 1/2 that I've done is not a bonus issue. It's not a bonus fraction. The bonus fraction we take into consideration the bonus issue shares plus the existing shares. That will give you the bonus fraction. So the bonus fraction will be 3/2, not 1/2. All right. So someone can decide to use a bonus fraction over here to find this one, which will be 3/2 times 100,000. The person will find the 150 direct. Okay. The bonus fraction will help you to find the total number of shares directly. Okay. So our bonus fraction, our bonus fraction, our bonus fraction is our bonus fraction is 3/2. Okay. Sometimes what you have to know is that sometimes the question will not give you the they will not give you the number of shares, and they will also not give you, maybe they will not give you anything to find the earnings yourself so that you can find it. No, they will just give you the earnings per share. They will not give you any further information again. So what you do is that you can adjust this particular earnings for the previous year using the bonus fraction. How do we do it? What we do is that we turn the bonus fraction upside down. If you multiply by this, it means that you are increasing. So if you do like this, it means that you are going to be reducing, because the earnings per share will be reducing because the share has increased. So earnings per share will be reducing. So you change the fraction upside down and use that particular fraction to multiply the previous year earnings per share. So that will be 2/3 times 40 pesos. You will be getting the same value as 26.7 GP. So sometimes it is very simple if you use the bonus issue fraction. It's very easy if you use a bonus issue fraction. Let's pick a question on a bonus issue. Then we look at what we call a right issue. Question 2. At April 2015, D Limited had 7 million 1 city ordinary shares in issue. It made a bonus issue of 1 share for every 7 head on 31st August 2015. Its earnings for the year were 1,150,000. The D Limited's earnings per share for the year ended 31 March 2015 was 10.7 pesos. Required calculate the earnings per share for the year ended 31 March together with the comparative earnings per share for 2015 that will be presented in the 2016 account. Okay, I'm saying that the bonus issue, that if it is made on existing shares at the beginning of the year, the time doesn't matter. We don't time apportion. It is assumed to be in existence from the start of the from the time that the company started operating, and the time that the company started having reserves. The bonus issue will be assumed to be there. All right. So what we do now is what? What is the number of shares that the company is currently having? What is the shares in issue?
7 million.
So shares in issue is 7 million, isn't it? Okay. The bonus issue was made in a proportion of what? 1/7. 1/7. So what will be the bonus issue shares? How many shares are they going to be getting from the bonus issue?
1 million.
Okay. So the total number of shares will now be 8 million. Am I correct? Okay.
Yes, please.
Okay. Which you can also use the total number of shares. What will be the bonus fraction? Will it be 8/7?
Yeah, 8/7.
So someone can also use 8/7 multiplied by 7. And that person will be getting the total number of shares straightforward, 8 million. Okay. So let's now come to the earnings per share for 2016. So the basic earnings per share for 2016 will be 115,000 divided by 8 million. What are you getting?
$14.38 GP.
Okay, 14.38 GP. Okay, per share. Okay, so let's count to basic earnings per share for 2015, the comparative. What we do is that it was 10.7 GP, so we now reduce it by the bonus fraction. We reciprocate the bonus fraction by turning it upside down. Okay, that will give us what?
$9.36.
Okay, 9.36. Okay, so 9.36 GP. Okay, this 9.36 GP, you can decide to find it like this. You find the earnings first. You can find the earnings first. How do you find the earnings for the last year? The earnings for the last year will be the number of shares multiplied by the this value. Okay, so you'll be having 7 million. You'll be having, so this one change it to cities rather. So that would be 0.107. So you multiply by 7 million, what are we having? 7 million times 0.107. I'm getting
749,000.
Okay, 749,000. That is the earnings for last year. So if you want to calculate your basic earnings for last year now, you have to use your total number of shares now, including the bonus fraction. Including the bonus shares, that will give you 8 million. You should be having something like 9.36 GP. All right. But this one, they will not give you they will not give you enough information to be able to get this. So what we do is that just reduce it by the what? The bonus fraction. Turn the bonus fraction upside down and multiply by it. That is all. All right. Let's come to what we call a right issue. Right issue. Okay. The right issue is different from what? The bonus issue. All right. But what you have to know is that bonus issue does not come with additional cash. There is no cash. But the right issue will come with additional cash, but there will also be a bonus element in it. Okay. What is going to happen is that the shares will be having a current market value, of 3 cedi. But the right issue will be made at a value lower than what? The current market value. It means that there's a portion that is what? That is being issued at a bonus. So it will always be the right issue will always be done at a price lower than the current market value, because you are doing this to motivate the existing shareholders to what? To exercise their rights. The right issue is always made to the existing shares in the proportion of their ownership. So you are motivating them to buy. So you have to give it to them at a price that will be lower than the current market value. So the right issue will always be done at a price lower than the current market value. Since the price is lower than the current market value, it is assumed that portion of the shares is issued for free. If it is for free, that particular portion will be representing what? The bonus issue. So for right issue, there's a portion of full market value, and also there's a portion of what? A bonus issue. The portion of the full market value is the one that they are paying the money for. And the one that they are giving to them at a discount is being assumed as a bonus issue. So if you count to the right issue, you are going to be having issue with a bonus issue at the same time, issue with a full market value. How do we go about it? How do we go about it? The first thing that you have to calculate is what we call theoretical ex-right price. What is a theoretical ex-right price? Is the actual price of the shares after the what? The right issue. The actual price of the shares after the right issue. Why are we calculating the theoretical ex-right price? We want to know the right issue fraction. So we want to know the right issue fraction so that we can be able to calculate the bonus element. So the right issue fraction is calculated as a cum diff or cum x price, which is the what? The price before the bonus, the price before the right issue divided by the theoretical XY price. So what you have to calculate over here is that you have to calculate the theoretical XY price. How do we calculate it? The FM people will know that. Okay, it's very simple. It's very simple. It's very simple. It's not anything. It's not a big deal. All right. Let's assume that. Let's assume that. Oh, let's assume that we have a company currently. So the company has existing shares. Company has existing shares of 20,000. Okay. So the company has existing shares of 20,000. 20,000, which is currently trading at 3 cedi. Okay. And made a right issue. The right issue will also be made in a certain proportion. So the right issue, they made a right issue of 1 for 4. So they made a right issue of 1 for 4 at a price of 2 cedi. Okay. Let's now calculate the total value of the shares. What will be the total value of the shares and what will be the number of the shares? Let's come to the existing shares. What will be the value of the existing shares? In terms of value, what will be the value? Would that be 60,000 Ghana cedis?
Yeah, 60,000.
Okay. Bonus issue. What will be the value that it will be as a bonus issue? The right issue. What will be the value that they will be realizing from the right issue?
10,000.
Would that be 1/4 times the 20,000 times 2? Am I correct? Okay. That will be 10,000. So the total value of the shares now will be what?
72.
Okay, that will be 10,000. Let's count to the number of shares now. Let's count to the number of shares. What will be the number of shares that the company will be having? They'll be having the existing one of 20,000, isn't it? And the right issue, they'll be having 5,000 shares. Is that correct?
Yes, sir.
Okay, so the total number of shares will now be 25,000. Are you okay? Okay. What will be our new share price now? After the right issue, what will be our new share price now? Would that be 70,000 divided by 25,000?
Yes, sir.
Okay, and that will give us what?
2.8.
Okay, so the 2.8 is what we call the theoretical XY price. So that is the price of the shares after the right issue, 2.8. That's what we call the theoretical XY price. So this is calculated on total basis. This is calculated on total basis. We can also calculate this on unit basis. And the unit basis is the one that you are going to use in the exam because they will not give you the total number of shares. They will just give you the units. Okay. So if you're using the unit basis or the unit approach, this is what we do. Okay. You can see that we just applying a principle of weighted average. What do we calculate this one? We use the 2,000 multiplied by 3 cedi. We use the 5,000 multiplied by 2 and get this figure. So you count your existing shares. Let's count to the existing shares. Okay. On unit basis, how many of your existing shares are you giving out? Would that be 4? On unit basis, how many of your existing shares are you giving out? It's
Yeah,
4.
4.
Okay.
4.
So the right issue is what? On unit basis is 1 at what? 2 cedi. And that will give you 2. So this will give us 40. This will give us 5. So your theoretical extra price is just the 14 divided by 5, which will give you 2.8. Okay. All right. So your right issue fraction now, will be your existing market price, which is 3 divided by 2.8. That is what you are going to be using as the right issue fraction. Okay. So how do you apply the right issue fraction? So this is just like the bonus fraction. Okay. So this is the bonus fraction. So you come here and you find your bonus elements. So come to your existing shares. Your existing shares was what? Was 20,000. So 20,000 multiplied by 3 over 2.8. What are you going to be getting? I'm getting 21,429.
Yes, sir.
Okay. But the shares that we have at the beginning is what? 20,000.
20,000.
But it is now 21,429. It has increased by what?
1,429.
Okay. This 1,429 is the bonus issue. So your share, your right.
Please come again. Please come again.
The increase to this 20,000 represent a bonus issue. Is a bonus issue. Okay. But your right issue is 5,000. 14,429 out of it is a bonus issue. So what of it will be for the full market value? The bonus issue will be made out of what? The bonus issue is also included in the right issue over here, which is 5,000. So the bonus issue is 1,429. So what will be the full market value now? The full market value will be the difference between them. So you can decide to take this one for the full year, because this will be at the beginning of the year, plus the bonus issue will be there for full year. It's only the difference, which will be like maybe 35.71, which will be pool, or which will be time apportion, because this is the full market value. So the full market value will have the time that it was issued as to the reporting date. It will be the same impact that will be having on profit. Okay, but don't worry, I'll also show you another way of calculating it. This is the simplest way of understanding it. Okay, another way of also finding the bonus, if you want to find the portion of the shares that is issued as a bonus, just subtract 1 from this. Subtract 1 from this and see something. So that the bonus, the right issue fraction over here, subtract 1 from it. So those having calculator, subtract 1, let's see what we are going to be getting. It will be what?
0.0702.
Oh, no, just do it like a fraction. Let's see.
1/14.
1/14. Okay. Okay. So 1/14 multiplied by. Apply the 1/14 on 20,000 and see. This is now the proportion of the bonus issue. So 1/14 times the 20,000 and see what you are going to get. Are you getting the 1429?
1,429.
Okay.
Yes.
So that is also another way of you calculating the what? The bonus issue shares. Okay. That is not a problem. Let's take it one by one. Okay, let's take it one by one. Okay. All right. Let me see if I can get a question that is relating to only right issue. We deal with that one, then we come to let me see whether I can get. This also diluted. Let's see if I have a question on this issue. Okay, so this is it. Question 8. Question 8. Okay, let me pick someone here so that the person can read that question for us. So let's pick this one. Then we go and come back and pick a question on a mixture. Sometimes there can be a full market value and a bonus issue and then a right issue all together. How do you deal with them? Okay, so let's take Auntie Jocelyn, take the question 8 for us so that we know that we are done with this one. Then we go and come. Auntie Jocelyn, are you here?
Okay. Garfish had profit after tax of 3 million in the year ended 31st December 2007. On 1st January 2007, Garfish had 2.4 million ordinary shares in issue. On 1st April 2007, Garfish made a 1 for 2 right issue at a price of 1.40 when the market price of Garfish share was 2 Ghana cedis. Required, in accordance with IAS 33, earnings per share, calculate the basic and diluted earnings per share.
Okay. So this one, the diluted and then the basic earnings per share, they'll all be the same because there is no issue that is going to be diluting the shares over here. But our focus is on the right issue. Okay. Our focus is basically on the right issue. All right. So the company is having profit after tax of 3 million. The company is having profit after tax of 3 million. So profit after tax of 3 million Ghana cedis. Okay. Let's look at the shares that the existing shares that they have now. The existing shares that they have now. Okay. They have 2.4 million in issue. That is the shares at the beginning of the year. Okay. So shares in issue. Shares in issue is 2.4 million. Okay. So there was a right issue. Right issue in the proportion of what? 142. Am I correct?
Yes, sir.
At a price of what?
1.4.
Okay, at a price of 1.4. Okay. If you are calculating the theoretical XY price, the question can give you a par value. They can give you a par value of the shares. We always use the current market price of the shares. The par value is just the value attached to the shares at the time that you are registering the shares. It can be 50 pesos, it can be 1 cedi. But we always use the current market price of the shares, which is the SDIF share price of what? Of the shares. Okay, so the question has given us that as what 2 cedi. Okay, so let's now calculate our theoretical extra price on a unit basis. Okay, so we look at the existing shares. Existing shares. How many of the existing shares are we bringing? How many of the existing shares are we bringing? It is 2, isn't it? It's 1 for 2. So that will be 2. 2 at 2. Okay. 2 at 2. So 2 at 2 will give us 4. Will give us 4. The right issue will be 1 at 1.5. 1.4 rather. Okay. So this will give us 5.4 and this will give us 3. So our theoretical extra price will be 5.4 divided by 3. What are we getting?
9/5.
Okay, 9/5. So that will give us 9/5. So our right issue fraction will now be calculated as 2/9/5. Okay, this one, you can just use some small idea of board mass to be able to go about it. That will give you 2 times 5/9. That will give you 10/9. Okay, so that will give you 10/9. That is your right issue fraction, 10/9. All right. What we have to do now, we know that right issue is having part of bonus issue and also part of full market value. So let's now find the shares that we are going to be issuing through the right issue. What is the shares that we'll be getting? It will be 1/2 times 2.4 million. Is that correct?
Yeah.
Okay. And that will give us 1.2 million. Okay. Okay. So let's now find a WACC. How do we go about the WACC? Okay. So I will show you 2 ways of going about the WACC. I will show one approach which I will have the existing shares over here. Okay. The existing shares, what I will do is that I will multiply the existing shares, which will be 2.4 by the right issue fraction, 10/9. What are you getting? 2.4 times 10/9. I'm having 2.67.
2.67.
Okay. What is the difference? It was 2.4, now it is 2.67. What is the difference?
$0.27.
Okay. So the difference is 0.27. Okay. You see that 0.27 is a bonus issue. So the 0.27 is a bonus issue. So what will be the full market value issue now? Let me take the year first. Okay, it was 1st April. Okay, so it's December. So the total shares that we are getting from the right issue is 1.2, isn't it? And we are saying that 0.27 is a bonus issue. So what will be the full market value issue now? So April to December will be 9 months. So we'll be having 1.2 million minus 0.27 times 9/12. Okay, that is the first way. The bonus issue and the existing shares will be from the beginning up to the end of the year, full year. But it will be the full market value that is going to be doing only 9 months because the right issue was done at April 1. So that will be only the 9 months. So let's calculate that, and I'll also show you another way of going about this. Okay. So 1.2 minus 0.27 times 9/12. I'm getting 0.70. Can someone confirm that? Okay.
Yeah.
3.37. That is this one way of getting it. Let's go to the next one. Next one where we are going to be using the fraction. Okay. So our work will be calculated like this. So we count to the existing shares. So the existing shares, what will happen is that we calculate the existing shares, but we time apportion it because the existing shares was there from January to March, and April there was what new shares. So what we do is that the existing shares will be 2.4 times the 10/9 times 3/12. Why 3/12? This is going to be there. So we apply the bonus fraction on it, and this is going to be there for 3 months before the right issue. So let's get what we are. Let's calculate what we'll be getting for this 2.4. Then, so you apply the bonus fraction or the right issue fraction up to the time that the right issue is done. So that will be that. So this will be January to March. Okay, let's count to April to December. April to December, our total number of shares will now be 2.4 plus 1.2. And this will now last for 9 months. Okay, let's see what we are going to be getting. 2.4 times 10/9 times 3/12. The first one I'm getting 0.67. The last one, what am I getting? 3.6 times 9/12. I'm getting 2.7. 3.37. Okay. So the one that you like, you pick it. But the first one will be very okay for you. If you multiply that one by the right issue fraction, the increments in the existing shares represent the bonus issue. So just find the bonus issue shares from the what? From the full right issue, because the right issue comprised of bonus issue and full market value. So if you take the bonus issue from the right issue shares, the remaining one will be the full market value, which you are going to now time apportion, because bonus issue on existing shares is not time apportion. So let's count to our basic earnings per share here. Our basic earnings per share will be the 3 million over 3.37 shares. What are we getting? I'm getting 89 GP. Is that correct?
Yes, sir.
It's quite from the 3 million.
3 million is the earnings for the year. Profit after tax is 3 million. It's given in the question. Garfish had profit after tax of 3 million in the year ended 31 December 2007. All right. Okay, so let's go and come and look at the combination of the. There you can have a question where you have a bonus issue, you have a right issue, you also have a full market value. How do you go about it? Let's go and come. Then we look at a question like that. Then we move on to diluted earnings per share. All right. Okay. So question 8, question 9, financial reporting, group reporting people. That is a question that you'll be seeing in the exam. So you can start. That will be the question that you'll be seeing in the pre-mock. So you can start solving it. It's a free report I'm giving to you. Okay. Okay, so let's go and come in 5 minutes, and we continue with the other ones. All right.